Thank you, Chairman Issa and the Ranking Member, Representative Cummings, for holding this hearing and for inviting me here today. I'm a frequent watcher and a loyal viewer of this committee on C-SPAN, so I appreciate the invitation to be here with you today. My focus of my remarks this morning is going to be on Section 1342 of Obamacare, which I, in partnership with your colleague Tim Griffin of Arkansas, have introduced legislation to repeal. Now, Section 1342 deals with what already has been described as risk corridors. Now, under normal circumstances, risk corridors are a valid program. They provide insurers insurance against unanticipated major losses caused by anomalies that may occur in a competitive insurance market. This prevents disruption in services, for example, for patients and for customers. And if they're budget neutral, by the way, these risk corridors can actually protect taxpayers from assuming too much of the risk. The problem with a risk corridor in Obamacare is that this is not a normal circumstance. First of all, its failures are not anomalies. They are across the board. It's not one or two companies that are miscalculating on Obamacare's long-term prospects. It's the entire industry that's being affected by its failures. And by the way, Obamacare and its exchanges are not a true competitive insurance market. In fact, it has increasingly become more like a high-risk pool. The risk of a bailout has always been high. As many of us predicted, these exchanges have not attracted enough young and healthy people to sign up. But the chances of the bailout have increased significantly in the last few months due to several unilateral actions taken by the President and by his administration. For example, this past November, in response to a public backlash from people who were losing their health plans and providers, President Obama delivered a speech in which he announced his unilateral action to, quote, fix his broken promise that if you like your plan, you can keep your plan. That same day, however, the Department of Health and Human Services issued a press release to go with the President's speech. And in that press release, they added a critical detail that was missing in the President's remarks. And here's what the press release said, quote, though this transitional policy was not anticipated by health insurance issuers when rate setting for 2014, the risk corridor program should help ameliorate unanticipated changes in premium revenue, end quote. Now, what this means is pretty straightforward. The rates being charged by the insurance companies and the exchanges were based on a certain number of young and healthy people signing up. But because that isn't happening, companies in the exchange will not be able to offset the costs of insuring older and less healthy individuals. And as a result, the risk corridor will be needed to bail out the companies for their losses. Now, the administration and the law's supporters deny that this is where we're headed, but the proof already exists that a bailout will be required. For example, earlier this year, health insurance companies had to file their key disclosure documents with the Securities and Exchange Commission. In it, they had to explain to their shareholders what Obamacare will mean for their bottom line in the coming year. And here's what it said. It will mean losses. That's why, based on these filings, the credit rating agency Moody's has downgraded the outlook for American health insurers to negative status. So health insurers are leveling with their shareholders about how Obamacare's failures will affect their bottom lines, and credit rating agencies are leveling with investors about how Obamacare's failures affect the health insurance industry. Now it's time for the President, for Secretary Sebelius, and for Obamacare supporters to level with taxpayers about the fact that their hard-earned tax dollars will soon be needed to bail out the Obamacare exchanges. The supporters of Obamacare have defended the risk corridors by citing how it has worked for Medicare Part D. But these are two fundamentally different programs. Medicare Part D deals with defined, a limited, and a predictable population of seniors. Insurers knew who was going to sign up, and they had a pretty good idea of how much they were going to cost to insure. And so they could price for it accordingly. But Obamacare exchanges deal with an open-ended, broad, and unpredictable group of enrollees. No one knew who was going to sign up, how many would sign up, and how much they would cost. But what they're now finding out is that the pool of enrollees that is signing up is smaller, older, and unfortunately sicker than what they had priced for. And soon they will be coming to Washington for their bailout to cover their losses as a result. Now, the law has a host of other problems. For example, as the chairman has already pointed out, just yesterday, the Congressional Budget Office found that Obamacare will cost millions of Americans their jobs, and it will add trillions in additional deficits. That, by the way, is why a growing number of Americans have come to realize that this law has so many flaws that it cannot be fixed. Now, I respect the fact that there are some who still hold out hope that Obamacare will work, just like there were some in Denver this Sunday still holding out hope that the Broncos could come back and win in the fourth quarter. But no matter how you may feel about the law, we should all be able to agree that the American people should not have to pay for another taxpayer-funded bailout. Refusing to take that possibility off the table is like basically telling the American people that some are so devoted to protecting Obamacare that they do not care how much it will cost taxpayers. The bottom line is that it is not right to allow a powerful industry to use its influence here in Washington to protect itself from the consequences of Obamacare. And it is not right that hardworking Americans are forced to pay for it.